My name is Michael Hermes. I'm a financial advisor here at Horan. Everyone on the call today, I'm sure you're very excited to go over Social Security and Medicare planning. My specialty is really in Social Security as well as financial planning and investment management. My colleague who will be joining after, Nate Epp, he will spend about 45 minutes or so going over Medicare and everything you need to know there. And I will spend the first 45 minutes or so talking about Social Security and different strategies that you can use to maximize your benefits. Even if you've never contributed into the system before, you might still be eligible to get something out of Social Security, as well as all those little tips and tricks that they don't tell you until you actually apply for your benefit amount. And so with that being said, we're just going to kind of jump right into it for the sake of time. If you're ever working with a financial advisor, one thing I like to throw out there before the presentation begins is if you're ever working with a financial advisor, you want to make sure that you're working with a fiduciary. So hopefully everyone has heard that term before, fiduciary. But essentially what a fiduciary is whoever you're working with has to make sure that they have your best interests in mind when giving you recommendations. So they can't just sit there and sell you a product. Every recommendation that they make you has to be in your best interest. At Horan, all of our advisors are fiduciaries. One quick way of knowing if you're working with a fiduciary is if they have the letters CFP after their name. It stands for Certified Financial Planner. And so if you're ever working with an advisor, just make sure that you are working with a fiduciary. But once again, my name is Michael Hermes, and we're just going to jump right into it to talk about Social Security and everything you need to know there. And so we have a little bit of a big agenda. There's about 9 bullet points that we're going to touch on throughout this presentation. So will Social Security be there for you? I get asked that question a lot, and I think there's some misconceptions that hopefully will clear up before the end of the day. How much you can expect to receive in Social Security benefits, when you should apply for your Social Security and different strategies that you can utilize to maximize those benefits. If you or your spouse has a non-covered pension, so you were contributing to something other than Social Security throughout your career, how that might negatively impact your retirement benefit from Social Security, as well as some of the other strategies, how your Social Security is taxed, how you actually apply for your benefit, and designate a representative payee, and lastly, how it all fits into your retirement picture. And so with that, will Social Security be there for you? So every single year, the Social Security Administration releases their annual results. So this is the end of 2019. So at the end of 2019, every single year, about $1 trillion comes into the system via taxes on your paycheck. And then every single year, about another $1 trillion leaves the system in the form of benefit payments. So actually, at the end of 2019, there was a little bit of a surplus of about $2.5 billion. And that surplus goes into the Social Security Trust Fund, sitting there earning interest, ready to be paid out in case there's no more surplus. So that trust fund is sitting there in reserve. And so at the end of 2019, that trust fund currently sits at $2.897 trillion. Which sounds like a big number, but in the grand scheme of things, it's really not. And so it's actually projected this year, 2020, going forward, there's no more surplus. So they're going to have to start dipping into that trust fund every single year to continue paying beneficiaries 100% of their benefit payment. And so without any sort of reform in the Social Security system, it's expected that by the year 2035, everyone will get roughly 79% of their benefit payment. So in the year 2035, that trust fund is depleted to zero, so the system can only pay out as much as it takes in every year. And so come year 2035, everyone will get 79% of their benefit amount. That's the projection. Okay, so yes, in a sense, Social Security is going broke. You'll still get something from the system, but it might not be the amount that you were originally expecting. Once again, that's without any sort of reform, and so there's a lot of different ways to fix the Social Security system. In Congress right now, there's a bill, it's called the Social Security 2100 Act. If this gets passed, everyone will get 100% of their benefit payment through the year 2100. And so how are they planning on fixing that gap in the system? really twofold. So currently, the first $137,000 of your pay is subject to Social Security tax. If you make more than $137,000, there's no more tax for Social Security payments. And so what they're going to do is increase the amount that is subject to tax. And so what they're going to do is if you make over $400,000 per year, the Social Security tax will kick back in. So that's the first way they're going to fix it, is increase the pot that is subject to Social Security tax. The second way is to increase the overall tax rate. And so currently, both you and your employer pay a 6.2% tax for Social Security payments. What they're going to do is increase that by another percent for both you and the employer to 7.2%, and they're going to gradually increase it to that level over the next 25 years. So really, how are they planning on fixing the system? Twofold: increase the amount that's subject to tax and increase the overall tax rate, and voila, you fix the system until the year 2100. Sounds simple, right? But granted, things aren't that simple. And so, like I said, that's currently in Congress. Keep your eyes posted on the news if you hear something about that. There's a lot of different ways that I think that they can approach fixing this issue. We'll talk about another one of those areas here in a little bit. But with the way it stands now, 2035, that's when that trust fund is depleted and everyone will get 79% of their benefit payments. All right, so how much can you expect to receive from Social Security? Hopefully everyone has looked at their statement before. If you haven't, this is the front page of your Social Security statement. So when you get it, in the top right-hand corner, there's a big bold number. And that number is the amount that you are eligible to receive at your full retirement age, which we'll talk about in a second. But how are they coming up with their Social Security benefit? The national average Social Security payment is around $1,400 a month or so. But the way that they're coming up with your benefit amount is they're taking the highest 35 years of your earnings history, plugging it into a formula, adjusting it for inflation, and doing some math, and out spits your benefit. Okay, it's too complicated to go over today, but the premise here is that they're using the highest 35 years of your earnings history. So when you get your statement, you will want to open it up to page 3. On page 3 of your statement, it will look something like this, and it shows every single year you contributed to Social Security and Medicare. Okay, so go through your earnings history and make sure it looks accurate. Make sure you don't have any zeros in there for years you in fact did contribute to Social Security, because if you do have a zero in there, it will negatively impact your benefit amount. Okay. The Social Security Administration says they're about 99% accurate with their reporting history, which means they can mess up 1% of the time. And we've seen it happen, and it typically happens to individuals who are ever self-employed. So go through, double check your earnings history, make sure it looks accurate, make sure you don't have any zeros in there for years you in fact did work and contribute. Okay. If you have 34 years of earnings, you're going through and counting up, and you have 34 years of earnings, and you're thinking about one more year, working one more year, delaying your retirement so that you hit that 35th year of contributions, I promise you the amount that you will pay in tax versus what you will get back out of the system, it's not worth it. Okay, I believe the break even on that, you have to live to be roughly age 160 to break even on that money. So if you have 34 years and you're planning on working one more year, it's probably better if you just go ahead and retire from a Social Security standpoint. But once again, go through, double check that earnings history. So when you turn 60, you should be getting your statement in the mail every single year. Before then, it's every 5 years. And typically when I say that, most people in the audience kind of look around and they say, well, I've never got my statement. And so if that's you, I would encourage everyone on this call today to go onto the Social Security website, create an account, and pull your most recent statement. Get an idea of what your benefit looks like. Get an idea of what the statement looks like. Okay? But go online, create an account. Once you create your account, they will stop mailing you paper Social Security statements. Okay, so you will have to log in to your username every single time going forward in order to view your statement. All right. So when should you apply for your Social Security benefit? Like I said, when you get your statement on the front page in the top right-hand corner, there's a big bold number. And that number is the amount you are eligible to receive at your full retirement age. So your full retirement age is when you can collect 100% of your Social Security benefit. So your full retirement age is also determined by the year you were born. So if you were born between 1943 and 1954, your full retirement age is 66. And then if you were born after 54, they kind of stagger it every 2 months until you were born 1960 and later, your full retirement age is 67. So fun fact, when Social Security was first started, the full retirement age was 65. Most people only live to be 65 though. And so nowadays, the latest full retirement age is 67, and most people live to be in their early 80s. So payments are being paid out a lot longer than they used to be. And so I wouldn't be surprised if in that legislation to fix Social Security, they start to extend this full retirement age back later and later. But once again, born between 1943 and 1954, your full retirement age is 66. Most people know this, but you don't have to wait until your full retirement age to begin collecting your benefit. You can take your Social Security as early as age 62, but each year you take it early, it is going to be discounted roughly 7% per year. So for example, in that chart there, if you look at that middle column, if your full retirement age is 66 and you start your benefit at 62, you're going to get roughly 75% of your benefit amount. And once you've taken Social Security, you've taken it. That's the amount you're going to get the rest of your life. Okay, so each year you take it early, it's going to be discounted roughly 7% per year. On the opposite end, each year you delay taking your benefit past your full retirement age, so not continuing to work, just delaying taking your benefit. So each year you delay taking your benefit until age 70, your benefit will increase a guaranteed 8% per year. And so same thing as last time, if you look at that middle column, if your full retirement age is 66 and you wait to apply until age 70, you'll get roughly 132% of your benefit amount. And so I actually had a consultation one time. I was meeting with a man, he was 72 years old. And he said, Mike, when should I start taking my Social Security benefit? And I said, well, you should have started taking it 2 years ago because your benefit doesn't continue to increase 8% per year after age 70. And so he called up Social Security, and the most that they would lump someone back was 6 months worth of missed payments. And so he missed out on 1.5 years worth of Social Security. So my point being, pretty much never wait past age 70 to begin collecting. Your age 62 amount, your full retirement age amount, and your age 70 amount are all highlighted on page 2 of your statement when you get it. If you read the fine print though, so and you're looking at your age 70 number on your statement and you read the fine print, the estimates that they are giving you assume that you continue to work until that age, making whatever you made this past year, okay? So if you are 66 and you're still working and it shows you that age 70 amount, more than likely it will be overinflated a little bit just because most people don't actually continue to work until 70, okay? So just keep that in mind. But all 3 of those benefit amounts are highlighted on page 2 of your statement. All right, so when should you apply for your benefit? 62, your full retirement age 70, sometime in between. If you ask 100 different advisors, you will get 100 different answers. And so everyone's situation is different. Just because your friend or your brother or sister did one thing does not mean that that is what you should do, okay? So some things to consider: your health status. If you don't think you're going to live very long and you're single, it might make sense for you to go ahead and start up your Social Security benefit. Get as much out of the system as you can while you're still living. On the opposite end, life expectancy. So if you do think you're going to live a long time and your family has good health history, it might make sense for you to delay taking your benefit until age 70. So for example, if you wait until age 70 to begin collecting versus taking it at your full retirement age, we'll say 66, you're missing 4 years worth of checks by delaying taking your benefit. And so the break even on that is roughly age 81, 82. So if you think you're going to live longer than your early 80s, it would make sense for you to wait to delay taking Social Security until age 70. The third bullet point there, need for income. So if you're getting ready to retire and you don't have any other sources of income, you'll need some money to live off of. And so more than likely you'll want to start up your Social Security benefit in that case. The fourth bullet point, whether or not you plan to work. This is a big one, and we see a lot of people mess this up, okay? With Social Security, there is something called the annual earnings test. What this talks about is if you take Social Security before your full retirement age, so 62, 63, 64, 65, and you continue to work, you cannot make more than $18,240 per year, or Social Security is going to withhold a portion of your benefit payment, okay? So once again, if you take Social Security before your full retirement age and you continue to work and make more than $18,240 a year, Social Security is going to withhold a portion of your benefit payment. So typically what we see happen is you're 63, you retire, you start up your Social Security early, so you're getting a discounted rate on your benefit amount, and then 6 months go by and you're bored, so you pick up some part-time work and you end up making more than that $18,240 a year number, or they actually check it monthly, so it's $1,520 per month. You end up making more than that $1,520 per month, and all of a sudden your Social Security check stops coming in the mail and you're wondering what happened. Okay, it's because you hit this earnings test threshold. And so the way this works is before your full retirement age, if you start Social Security early, you can't make more than $18,240 a year or $1,520 per month. The year you hit your full retirement age, so January 1 of the year you hit your full retirement age, that bumps up to $48,600 per year or $4,050 per month before you're subject to that earnings test threshold. And then the month you hit your full retirement age, so for me, November 1st of the month I turn, November 1st of when I turn 67, that's the month I hit my full retirement age, there's no more earnings test. I can make $1 million per year at my job and keep working, and I'm not subject to this penalty anymore, okay? So if you do continue to work, make sure that you don't take your Social Security payment before your full retirement age, so you're not subject to this annual earnings test, okay? Once again, it goes away at your full retirement age. If you messed up and you are subject to this earnings or this withholding, you don't lose the benefit forever. What they do is at your full retirement age, they will begin to prorate a portion of the amount that they withheld from your check back into your benefit payment. So if they withheld, call it, we'll just use estimates here, $2,000 from you, from your Social Security payment, they'll give you an extra $2 to $5 per Social Security check going forward, okay? Note that this earnings test is only on earned income. If you're receiving money from your investments, your IRAs, 401ks, if you're getting pensions, if you have a rental property, that does not count towards this earnings test. It's only on earned income through your employer, okay? So full retirement age, no more earnings test. So here's an example of that earnings test. So Janet was born November 22nd of 1957, which means her full retirement age is 66 and 6 months, or May 1st of 2024. So from age 62 until January 1 of 2024, she cannot earn more than $1,520 per month and collect Social Security, or she'll be subject to that withholding penalty. From January 1st, 2024 to April 30th of 2024, now the earnings test bumps up, so she can now make up to $4,050 per month. And then come her full retirement age in May of 2024, there's no more earnings test. So once again, if you kind of forget everything I said there, full retirement age, no earnings test. So now we're going to start to jump into different strategies that you can utilize to maximize your benefit amount. We like to say the Social Security office is kind of like a drive-through. You go in, you tell them what you want, and hopefully they'll give you what you ask for. They're not going to make sure that you are using the strategy that is best for your personal benefit. Okay? So they are strictly order takers. They are not financial advisors or planners. So this first strategy that we're going to talk about is the spousal benefit. So when you apply for your retirement benefit, you can get the greater of your retirement benefit or 50% of your spouse's benefit. Okay? You can get the greater of your benefit or 50% of your spouse's benefit. You don't get both. So in this example, Jane's PIA stands for primary insurance amount. It is the amount that you are eligible to collect at your full retirement age. So Jane's eligible to collect $2,000 a month off of her retirement benefit. Mike's eligible for $800 a month off of his. Instead of Mike taking his retirement benefit of $800 per month, he is instead going to collect his spousal benefit and collect half of Jane's $2,000 and get $1,000 a month instead of $800. So pretty straightforward. There's a couple rules about this spousal benefit. So the first one is that this does not impact Jane's benefit at all. She will still get her full $2,000. The only difference is that Mike is going to get $1,000 now instead of $800. Mike could have also been a stay-at-home parent his entire career. He could have no Social Security benefit. He can still apply for the 50% spousal benefit. In order for Mike to take the spousal benefit, Jane has to be collecting her Social Security. Okay, there used to be something called file and suspend, which would allow Mike to collect that spousal benefit without Jane collecting her retirement benefit. You can no longer do this. So going forward, Jane has to be collecting her retirement benefit in order for Mike to take the spousal benefit. The earliest Mike can begin collecting a spousal benefit is age 62. But each year he takes it early, it's going to be discounted roughly 7% per year. And so if he starts his benefit at 62, instead of getting the full 50%, he'll get roughly 75% of that 50%. On the opposite end, there are no delayed retirement credits on a spousal benefit, which means for every year you wait past your full retirement age to begin collecting the spousal benefit, it will not increase 8% per year. Okay? So if you're going to take the spousal benefit, never wait past your full retirement age to do so. Remember, too, that throughout all of these strategies, that annual earnings test still applies. So if Mike plans on taking his spousal benefit before his full retirement age and he's still working, he cannot make more than that $18,240 per year number, or else they'll withhold a portion of his spousal benefit. Okay. So that's the spousal benefit, greater of your benefit or 50% of your spouse's benefit. All right, I usually get to the slide. I get a couple cheers in the audience, but divorce spouse benefits. So if you are married for at least 10 consecutive years, you can get the greater of your benefit or 50% of your ex-spouse's benefit. If you get remarried, you lose the ability to collect a divorce spouse benefit. Okay? So once again, if you were married for at least 10 years, you can collect the greater of your benefit or 50% of your divorced spouse's benefit. Okay. A couple different rules on this one. Before, when I said Jane had to be collecting in order for Mike to take the spousal benefit, as long as your ex-spouse is at least age 62 and that divorce happened more than 2 years ago, you do not have to wait for your ex-spouse to begin collecting their retirement benefit in order for you to file for that spousal benefit off of their record. Okay? You can just start up your spousal benefit. Once again, they have to be at least age 62, and the marriage had to have been at least 2 years ago, or ended 2 years ago. All the same rules still apply, though. Other than that, 62 is the earliest you can collect a divorced spouse benefit. Each year you take it early, though, you're going to get less. There are no delayed retirement credits past your full retirement age, and that earnings test still applies. A couple tacky things about divorced spouse benefits. I could have been married 3 times, all of which lasted 10 years or more. I could have 3 ex-spouses collecting off my record. I don't know what's happening. It doesn't negatively impact my benefit, but technically I could have 3 ex-spouses collecting off my record, or vice versa. If I wanted to collect off one of their records, I don't get all 3, okay? I just get 50% of whoever had the highest benefit amount, okay? All right, that brings me to survivor benefits. So if your spouse passes away, you are eligible to collect 100% of their benefit amount instead of 50%. Okay, so in this example, Chris and Julie are married, both full retirement age. Chris's benefit's $2,000 a month and Julie's is $1,200. Chris passes, Julie notifies Social Security, and her $1,200 benefit is replaced by her $2,000 survivor benefit. So she's going to get 100% of Chris's benefit amount. Okay, so unfortunately, you don't get both. You just get the higher of the two. A couple things about a survivor benefit. Instead of age 62 being the earliest you can collect a survivor benefit, age 60 is actually the earliest age at which you can begin collecting this benefit amount. Also, survivor benefits work independently of your retirement benefit. And so what I mean by that is, say you're age 62 and your spouse passes away and you never began collecting your retirement benefit, you could start up your survivor benefit and collect off your spouse's record, and then your personal retirement benefit will continue to grow 8% per year until you turn age 70. So that at age 70, if your retirement benefit is higher than your survivor benefit, you can flip from your survivor benefit to that increased retirement benefit. Okay, so they work independently from each other. One strategy that we'll often see couples use is typically the spouse with the higher survivor benefit, or the higher retirement benefit rather, will let their benefit grow until age 70. So that way, if they pass away, the surviving spouse can collect 100% of that increased benefit amount. So it acts as some additional insurance. But once again, age 60 is the earliest you can take that survivor benefit, and that annual earnings test that we spoke about still applies. On another note, if you look at that last bullet point at the bottom there, if you are married for at least 10 consecutive years and get divorced and your ex-spouse passes away, you can collect 100% survivor benefit off of their record. So if you get remarried after age 60, you lose the ability to do this. If you get remarried after age 60, you can continue to collect that survivor benefit. So if you get remarried before age 60, you lose that ability. You get remarried after age 60, you can continue to collect that survivor benefit. So we actually had a client one time, they were 59 and a half. They didn't know about this rule. Her ex-spouse passed away, and at 59 and a half, she got remarried. And so if she would have waited 6 more months, she would have had the ability to collect a survivor benefit off of her deceased ex-spouse's record. And so our advice to her was to temporarily get divorced for 6 months. At age 60, start up her survivor benefit off of her ex-spouse's record, and then get remarried at age 60. And so technically, in the eyes of Social Security, it should have worked. However, if for all of you wondering, no, she didn't actually go through with it. All right, dependent benefits. So we have a client at Horan who is his full retirement age and collecting his Social Security retirement benefit, and he is about to welcome his 7th child into this world. And so if you have a child who is under age 18 and you are collecting your Social Security retirement benefit, they are eligible to collect 50% of your benefit amount through age 18, or 75% of your benefit amount through age 18 if you pass away. Okay, so we'll take a look at that example. Same as last time, Chris and Julie are married, both full retirement age, except now they have a child, Johnny, who's 15. Chris's benefit's $2,000 a month, and Julie's benefit is $1,200. Chris passes, Julie notifies Social Security and her $1,200 benefit is replaced by her 100% survivor benefit, same as last time, except now Johnny can also collect 75% of Chris's benefit amount and get $1,500 a month. Or if Chris was still living when he was collecting his benefit payment, $1,000 a month through age 18, as long as he's enrolled in high school. We don't see it happen too often, but it is a strategy that's out there. Typically what we see is you might have legally adopted a child or a grandchild. They would still be eligible to collect this. All right, restricted application. So this is the one really complicated strategy that's left in Social Security. And if you're eligible to do this strategy, I would encourage you to do it. I have seen this make the difference of roughly $100,000 over the course of someone's life. So if you're eligible to do this, I would encourage you to do this. As you could tell from my language I used, if you are eligible to do this, in order for you to be able to do this, you had to have been born on or before January 1st of 1954. Okay? You had to have been born on or before January 1st, 1954. And that would give you the ability to file what's known as a restricted application. So the way Social Security works now is when you collect your Social Security retirement benefit, if you are also eligible for a spousal benefit, you're just going to get the greater of the two. You do not have the ability to pick and choose which one you want to take. Okay? It's called deemed filing. With restricted application, this gives you the ability to separate the two, your spousal benefit from your retirement benefit, so that they work independently. Okay? So we'll go through this example. Hopefully it makes a little bit more sense. So Mike and Jane are 66. Mike was born before January 1st of 1954, which makes him eligible for a restricted application. Mike's eligible for $2,000 a month, and Jane's eligible for $800 a month. Instead of Mike taking his retirement benefit and having Jane take the spousal benefit, Jane's going to file for her retirement benefit at age 66. Okay, she's going to start collecting $800 a month. Mike, who was born on or before January 1st of 1954, is going to restrict his Social Security application to just his spousal benefit. He's telling Social Security, I don't want to touch my retirement benefit. I just want to take my spousal benefit. And he's going to start collecting $400 per month off of Jane's record. In the meantime, because he restricted his application, his personal retirement benefit is going to continue to grow 8% per year until age 70. At age 70, he's going to flip from his spousal benefit of $400 a month to his increased retirement benefit and begin collecting $2,640 per month. At that time, now that he is collecting his retirement benefit, Jane can switch from her retirement benefit to her spousal benefit and collect half of Mike's PIA, which was $2,000 a month. So she will get $1,000 a month spousal benefit. And so there's flip-flopping of records going on here, but essentially what's happening is Mike is getting a free spousal benefit until age 70. Once again, if you're eligible for this benefit, I would encourage you to take a look at it. Just know we do not expect anyone to become a master at any of these topics. Just know that you have a resource that you can utilize. We do not charge any sort of fee to talk about Social Security planning. All right, that brings us into windfall elimination provision and government pension offset. So with Social Security, if you have a non-covered pension, and so what I mean by non-covered pension is you have a pension from a public employer, such as in Ohio here, the Ohio Public Employee Retirement System, OPERS, or the State Teachers Retirement System. So some sort of pension that you are contributing to instead of Social Security, there are negative repercussions to that in regards to your Social Security benefit payments and the strategies that you can utilize. And so this is some of the most complicated aspects of Social Security to discuss. The first one, though, we'll talk about is the windfall elimination provision. Okay. And so with the windfall elimination provision, this applies to people who have both Social Security and a non-covered pension, so STRS or OPERS, okay? What you have to do is if you worked for Social Security or if you contributed to Social Security for more than 30 years, there is no penalty on your Social Security payment. You will get your full pension and you'll get your full Social Security. If you contributed to Social Security for less than 30 years, they will withhold a portion of your benefit payment. So what you need to do is you need to open up your Social Security statement to page 3 and count how many years you contributed to Social Security. If you contributed less than 20 years, the most that they can withhold off of your payment is $480 per month. Okay, so what you need to do is count up the years that you contributed and subtract the corresponding amount from your Social Security benefit, and that should give you a good estimate as to how much you could expect that windfall to be. This is not reflected on your statement anywhere. You just find out about this when you apply for your benefit, okay? But this will at least give you a good estimate as to what you can expect that withholding to be. With windfall, you'll always get something from Social Security. It will just be reduced, okay? So once again, windfall elimination provision applies to you if you have both Social Security and a non-covered pension. More than 30 years contributing to Social Security, there's no windfall. Less than 30 years, you'll have to deduct that corresponding amount. Government pension offset, this applies to people who have a non-covered pension and not Social Security, and they're going to try and take a spousal benefit or survivor benefit off someone else's record. Okay, unlike before, where there will be a reduction, but you'll always get something, with government pension offset provision, this could reduce your benefit payment to 0. And so what Social Security is going to do is they're going to take 2/3 of your non-covered pension amount, subtract it from whatever you would have collected from Social Security, and if that ends up being 0, then it's 0. And so in this example, John and Jane are married. Jane has a non-covered pension, OPERS, of $3,000 a month. John has a Social Security benefit of $2,000 a month. John passes and Jane's going to try and apply for her 100% survivor benefit and get $2,000 a month from Social Security. Under government pension offset, Social Security is going to say, hold up, you have this non-covered pension, so you're subject to GPO. And so they're going to take 2/3 of her pension amount, so 2/3 of $3,000 is $2,000, and subtract it from her survivor benefit of $2,000, and that ends up being 0. She's not going to get anything from Social Security for a survivor benefit. So if you are subject to government pension offset, that strategy I talked about before, where one spouse might wait until 70 to let their retirement benefit build up to provide a higher survivor benefit, if you are subject to GPO, it might not make sense for you to do that strategy. With these strategies, windfall and government pension offset, what you should do with them really comes down to the numbers themselves. So once again, feel free to reach out if you have any questions. And I know I'm kind of flipping through some of these slides for the sake of time. We will send out a recap, including all the slides, as well as a link to the presentation as well. All right, we're getting towards the end here. I got a few more minutes. So with Social Security, just know when you begin collecting your benefit, it is subject to tax. Okay, most people are shocked to find that out. And so the reason I bring this up is that most people, and when you apply for your benefit, Social Security does not ask if you would like to withhold anything for tax. So when you apply for your benefit, more than likely you will tell them, yes, please withhold something from my benefit amount for tax. All right. If your income, if your provisional income, and what provisional income is all your income excluding Social Security, plus 1/2 of your Social Security benefit, plus tax-exempt interest. I don't know how the IRS comes up with this stuff, okay? But if your income, essentially what it boils down to is if you're married filing jointly and your income's over $44,000, up to 85% of your benefit is subject to tax. So what that means is you'll get 15% of your Social Security benefit tax-free. The other 85% you have to pay income tax on. For most retirees, it's 10 to 12% or so. If you live in Ohio, Kentucky, or Indiana, there is no state or local tax on your benefit, but it does go state by state. Some states do tax a portion. But once again, the reason I bring this up is when you apply for your benefit, more than likely, make sure to tell them to withhold something for tax. You can choose between 7, 10, 12, or 22% federal income tax withholding, and you can change it at any time. All right, so how do you apply for your Social Security benefit? You have 3 options. Well, I guess 2 with COVID right now, but you can either visit your local Social Security office. You can call and schedule a phone appointment. There's the 1-800 number. Call at 7 a.m. to avoid those wait lines. Typically, hold time is around an hour to an hour and a half. Or 3, we help people do this all the time. This is the way that I would recommend doing it. File for your benefits online. Takes about 30 minutes. Okay, the application is pretty straightforward as well. The only thing with this is you cannot file for a survivor benefit this way. You do need to go visit your local Social Security office to file for a survivor benefit. But you'll do this process 3 months before you want to begin collecting. So if you want to begin collecting at your full retirement age, 3 months before you hit your full retirement age, that's when you'll start filling out and submitting the application to begin your benefit. Also keep in mind that your checks come a month in arrears. Okay, so if you file for your check to arrive in January, say your full retirement age is January, and that's when you put on your application you want your benefit to start, you are not going to receive your first check until February. Okay, and your check will always arrive on a Wednesday, and the Wednesday that it comes on is determined by the day you were born. So if you were born the 1st through the 10th of a month, then you will get your check the 2nd Wednesday. If you were born the 11th through the 20th, your check will arrive the 3rd Wednesday, and the 21st through the 31st, you will get your check on the 4th Wednesday. Once again, when planning for retirement, just to make sure there's no lapse of income, if you apply for your benefit to start on January, you do not actually get your first check until February. Social Security introduced a new thing this year when applying for your benefit, where you can label an advanced designation of a representative payee. Okay, so essentially with Social Security, they do not recognize legal documents, legal financial powers of attorney. Okay, you need to put on your application trusted contacts that if something were to happen to you, trusted individuals that can collect and spend your Social Security check for you if you are mentally incompetent. Okay, you can name up to 3 of these representative payees when you fill out your application. You can even do this before you submit your application. Once again, Social Security does not recognize financial powers of attorney, only who you list as a representative payee. So after this call today, I would encourage everyone, once you've logged onto your Social Security account, to list those trusted contacts of yours as a representative payee. All right, last slide here. I meet with a lot of retirees. The biggest question I think I get in retirement is, you know, Mike, I have all these different accounts and these different pensions. How much money can I live off in retirement without running out of money? Okay, how much money can I live off of without running out of money? And so this is the quick way of you figuring this out. So what you're going to do is you're going to add up all your investment accounts. Okay, so IRAs, 401ks, 403bs, 457s, et cetera, add them all up into one big pot. We'll call it $1 million for easy math. As a general rule of thumb, a conservative retiree investment portfolio should make between 4 to 5% per year. So if you have $1 million sitting in retirement accounts and you take 5% per year from your account, that's roughly $50,000 a year. So once again, the whole idea is you make 4 to 5% per year and you take 4 to 5% per year. So your account kind of stays the same throughout retirement. That's the general rule of thumb. So you have $1 million, you take 5% per year, that's $50,000 a year, or roughly call it $4,400 a month in retirement income from your investments. You're going to add that monthly amount to your Social Security, to your monthly pension benefits that you might be eligible for, and any monthly annuity income streams that you might have as well. And that's how much income you have coming in from all your different sources per month in retirement. Okay, so withhold maybe call it 12% for tax, and that's how much money after tax that you can live off of in retirement. So when planning for retirement, make sure your expenses are under that number. Once again, if you have questions about this, we're happy to sit down with you and help you figure this out as well. We do not charge just to talk. So with that, I appreciate everyone's time today. Thank you very much for coming out. I am going to hand the presentation off to Nate, and my contact information is at the end there. If you have any questions, do not hesitate to reach out. Always happy to help. But once again, thank you for your time today. And with that, I will hand it off to Nate to do Medicare.
All right, great job, Mike, as always. Give me a second here and we'll get everything flipped over. PowerPoint. All right. Okay. All right. Okay. Thanks for your patience here, getting us set up. So on the Medicare side of our business, Horan is an independent insurance broker. So what that means is when you need assistance with navigating Medicare, we assist with getting you signed up for Medicare, answering your questions, and we also are contracted with about 10 different insurance companies. So when folks come to us and they need assistance with Medicare, we help them research all the various insurance companies, look at their needs, and help them figure out of all these companies, which plan through which company best fits your particular needs. So, and one thing about all this, I get this question a lot, is how much does all of this cost? So, what are the fees? There actually are no fees. So as a licensed agent, what's in it for us is that when we help someone figure this out, when we help you get enrolled through a particular insurance company, they actually pay us a commission because we stepped in and we helped you figure this out. And we're actually not even allowed charging fees, even if we wanted to. So there is zero cost for you to get our help, and there is no impact on the premium of your plan or the benefits of your plan. So you're simply getting our help at no additional cost. So just a fair warning here, we are unloading a ton of information on you today, and I realize it's a ton of information to take in all at once. So again, we'll be sending copies of the presentation and as well as a recording, and we'll have a little Q&A at the end if you have any questions throughout. So we'll jump right in here, and for whatever reason, my presentation is not jumping straight into the presentation view. So I'll try to zoom in here a little bit on the slide. Okay, birth of Medicare. So Medicare started in 1965, and it is designed for 3 groups of individuals. Your first group of individuals are those who qualify for Medicare based on their age. So you're first eligible to start on Medicare the first of your birth month that you turn age 65. So let's say your birthday's today, it's July 22nd. You turn 65. You're actually eligible for Medicare July 1st. So it always goes back up to the first of your birth month. If you happen to have a birthday actually on the first of the month, you can actually start a month before. So if your birthday happens to fall on, let's say, July 1st, you could actually start June 1st. So I always have a couple people in the crowd that have a birthday on the first of the month. So that's the group that we see the most often, are those who qualify based on their age. The second group of individuals, this is actually folks of any age. So we have some clients in their 40s and 50s that are on Medicare because they are on Social Security disability. So once you're on Social Security disability for 24 months, you have to be on there for 2 years. Once you're on there for 2 years on disability, you are automatically enrolled in Medicare on your 25th month. So that is the second group of individuals. The third group of individuals, we don't see this too often, maybe once or twice a year, are those of any age diagnosed with end-stage renal disease, that's permanent kidney failure, or ALS. Diagnosis of either of those also qualify you for Medicare. All right, so those are your three groups of individuals. And Medicare has 4 different parts. Part A, B, C, and D. You're going to kind of feel like we're going through half the alphabet today. But just so you know, out of these 4 parts, the first 2 parts listed there, Part A for hospital, Part B for medical, those 2 parts are the government portion of Medicare. Okay, so the government is providing Part A and Part B. Part C and Part D, and there's another product called Medicare Supplement. Those are actually insurance products sold by insurance companies. Okay, so there's a government portion, and then there's an insurance company portion. So as we get later on in the presentation, I'll kind of show you how all of these work together and what you need to know about these parts. Okay, before we get to those 4 parts, there are a lot of rules with Medicare. And there's a lot of misconceptions out there and myths around Medicare. And I'm going to go over some of the more common ones that we typically hear. So the first one here that I've talked to some folks and they believe that Medicare is just automatic for everybody. As soon as they hit 65, it just happens automatically. That actually is true for some people, but not everybody. It is automatic if you are collecting Social Security prior to age 65. So if you start collecting Social Security at 62, 63, 64, when you hit age 65, you actually are automatically enrolled in Medicare when you turn 65. But if you're not collecting Social Security, when you hit age 65, you are not automatically enrolled. Nothing is going to happen unless you actually filled out the Medicare application. Okay, so it's automatic for some people, but not for everybody. Number 2 here, if Part A is delayed, there will be penalties. So, you know, we don't hear this too much anymore, but I still get it every once in a while where there's basically 3 penalties in Medicare that you have to keep in mind. We're going to talk about 2 later on. But this one in particular basically says that as long as you or your spouse, either one of you, have worked at least 10 years of your life paying Medicare taxes, there is no penalty with Part A. There is no cost to Part A. So you don't have to worry about that at all as long as you have that work history under your belt. If you don't, then there actually is a cost to Part A. All right, number 3. So out of all these myths on this list, I would say I hear this one the most. So if you only remember one of these, this is the most important one to remember. So the myth is that everyone is required to enroll into Medicare at 65. Okay, this is true for some people, but not everyone. All right. So here's how the rule works. The rule says that if you are turning age 65 and if you have health insurance coverage through an employer, okay, so this could be your employer or it could be your spouse's employer. And as long as that employer has 20 or more employees, then you are not required to sign up for Medicare at 65. Okay, so as long as you have health insurance coverage through your employer, 20 or more employees, you do not have to sign up at age 65. You are allowed to delay enrolling in Medicare. You can stay on your employer plan. You can delay Medicare with no penalty until you're ready to come off that plan, either at the employer's annual enrollment period or at retirement. So I'm talking to people now that are, in their, upper 60s, early 70s. They're now going to retire. They have not been on Medicare this whole time. They've been on their employer plan, and they're going to be just fine. There is no penalty. Okay, so, but if you're, working at a company, if it's less than 20 employees, then you do have to sign up for Medicare. So that's the threshold. It's the 20 employee mark. So that's an important one. I get a lot of questions on that. So just keep in mind, if you have employer coverage, you're hitting age 65, you don't have to sign up. However, that is an opportunity for you to come off of your employer plan if you wanted to. Okay, so turning 65, it does count as a qualifying event where you are allowed to come off of your employer plan, go on to Medicare. Now, whether that is a good idea for you or not actually depends on multiple things. Okay, so you want to look at how much are you paying for your employer plan? What are the benefits of your employer plan? You know, is it really expensive? Does it have a really high deductible? You know, when we go through this presentation, I'm going to give you some approximate costs of what Medicare looks like and what the coverage would look like if you went on there. So what you want to do is compare what your employer plan is offering, what Medicare is offering, and figure out which one makes the most sense. So that's part of my job too, is to help people make that comparison, and I can give you my recommendations on which one I think makes the most sense for you. All right, number 4. The most recent example I've heard of this, I had a gentleman call me and he said that I'm turning 65 soon, and yeah, I work at a fairly large company, and I'm turning 65. My boss says that I have to go on Medicare. I'm no longer eligible for the employer plan. That's actually not true. So just so you're aware that there are age discrimination laws in the country that say as long as you're an active employee and you're working the number of hours necessary to qualify for benefits at work, you're entitled to those. So just because you hit 65 does not mean you have to come off your employer plan. You're entitled to keep it. You don't have to go into Medicare. All right. All right, number 5, last one here is about health savings accounts. Okay, so with health savings accounts, this has become a very hot topic when it comes to Medicare and employer plans. So the myth is that you cannot have an HSA after you turn 65. Okay, so here's the rule. The rule says that if you enroll into Medicare when you hit age 65, at that point, you can no longer contribute into your HSA. Okay? So, but remember, the rule is that if you hit 65, if you have coverage through your employer, you don't have to sign up for Medicare. So, I hear this all the time where people call up and they say, hey, I know I was told that I have to at least get Part A of Medicare. That's not true. You don't have to do that. But it's optional. So whether you should sign up for Part A of Medicare or not depends on what type of employer plan you're on. So if you're on an HSA, my advice is do not enroll into Part A of Medicare. That way, you can keep putting money into that HSA after you hit age 65. But if you're not on an HSA, let's say you're just on a traditional plan that has like copays for doctors and medications, if you wanted to sign up just for Part A of Medicare at 65, there is no downside to that. There's no cost to Part A. It'll act as a secondary insurance plan to your employer plan for any hospital-related expenses, inpatient hospital. So that's something to think about too when you hit 65 is should you get Part A or not? It really just comes down to what type of employer plan are you on? Is that HSA important to you? If it is, don't sign up for any part of Medicare, and then you can keep putting money into that HSA. So we have a couple slides later about HSAs that are important that you need to know. We'll do that at the end, but we'll continue on here, and we'll jump now into those 4 parts of Medicare that we mentioned at the beginning. So first part here is Part A of Medicare. So remember, there are 2 parts the government provides, Part A and Part B. Under Part A of Medicare, this is your inpatient hospital care, skilled nursing facility, and hospice. Now, another myth of Medicare is I hear times where folks just believe that Medicare just covers all of your medical expenses. That is false. So I'm going to just go through this top bullet point here about Part A of Medicare if you had it just by itself. So if you didn't have any other insurance product, if you got admitted into the hospital, here's how this would work. Okay, you are responsible for a deductible. So right here it says there's a $1,408 deductible. Okay, that is your responsibility. Medicare will cover the rest. Now, an interesting aspect of this deductible is that it is not a calendar year deductible that you're used to. It is not a January through December deductible. It is what they call a benefit period, and it resets every 60 days. So if you get admitted into the hospital, you owe the $1,408. When you go out of the hospital, that's when the clock starts of your 60 days. So if 60 days go by from the time you're released from the hospital, and those 60 days go by and you happen to go into the hospital again, you'll owe another $1,408. If you happen to go in within that 60-day window, then you don't have to owe that deductible again. This is just after that 60-day period, you'll owe it again. So that is, a risk with Medicare is that if you had it just by itself, if you had a rough year and multiple trips, there's a chance you might owe that deductible multiple times. And, if you happen to be in the hospital for 60 days in a row, doesn't happen often, but it certainly does happen. You not only owe the first deductible, the $1,408, but once you hit day 61, now you're responsible for a per day charge of $352. If you happen to hit 91 days in a row, then they double that payment that you're responsible for up to $704 a day. So the moral of the story with Medicare, what you really need to know is that it provides some core like base coverage, but you want to have some other insurance product in addition to Medicare to help cover some of these expenses that we're seeing here. Okay, and we're going to get into those, what those insurance plans look like and what they cover and then what they cost here in a little bit. All right, that's Part A of Medicare. That's your hospital inpatient care. Part B of Medicare, this is all your outpatient care. Okay, so there's a lot that rolls up under Part B. You have doctor visits, that's primary care, specialists, ambulance, any kind of testing or lab work that's done. All of that rolls up under Part B. So remember back on Part A, there is no monthly payment. Part B does have a monthly payment. So as you're planning retirement and you are trying to figure out how much is Medicare going to cost, okay, this is the first dollar amount that you're going to write down. Okay, this is $144.60 a month. And if you're going through this with a spouse, that is per person. All right. Now, there's a little, in the parentheses here, it says it can be adjusted based on income. So I'm not going to dive in real deep on the different income levels, but just be aware that your income could impact how much you are responsible for Part B premium. Okay. If you're married filing jointly, if your income is $174,000 or less, then you're going to pay the $144. If it's over $174,000, then there's a series of like 5 different income brackets that you could potentially fall in, and then there's a monthly payment for that. So for today's purposes, we'll just use the $144.60 for your Part B premium. All right. So we just talked about what rolls up under Part B. That's all of your outpatient care. Now, how these services are covered. So I'm going to go through this basically as if you had Medicare just by itself and no other insurance. Okay. So under Part B of Medicare, there is a yearly deductible. Okay. This is a January through December calendar year deductible. It's very small. It's $198. You're responsible for the first $198 of your outpatient medical expenses. Once you hit that $198, then for the rest of that year, Medicare covers 80% of your expenses. You cover 20%. Okay, so Medicare is covering a pretty good chunk of your medical expenses. The issue with this 20% that you're responsible for is that there is no cap. There is no limit. Okay, so you start thinking about, maybe an outpatient rehab or, after a surgery or chemotherapy or an ambulance ride or specialist visits and multiple tests and lab work. You're paying 20% of everything, all of those medical expenses, and there is no limit to what you're responsible for. So again, moral of the story with Medicare is, while it does provide this base coverage for you, you do want to have some type of product in addition to this to help put a cap to some of these expenses. And again, we're going to get into this here very shortly. So that's the government portion of Medicare, Part A and Part B. All right, next slide here, Medicare cards. So I won't spend too much time on this, but just be aware that old Medicare cards used to have your Social Security number on it. So this Medicare claim number you see, where it's all zeros with an A, that used to be your social. They have now replaced everyone's cards with this new card, and now it's just 11 characters, just random numbers and letters. So for security purposes, they've removed your Social Security number from your Medicare card. But while this was happening, while this mailing was occurring, there was a huge scam that was going on at that time. People were getting phone calls, and there were fraudulent calls, and people on the other line would say, hey, we're from Medicare, we're from Social Security, and in order to mail a new Medicare card to you, we have to verify who you are. Please provide your name and your address and your phone number and your social. And people were just giving out all of their information, thinking that's what they had to do to get a new card, when in fact it was a scam the whole time. So just be aware that any changes that occur down the road with Medicare, it's almost a guarantee that there's going to be some type of scam attached to it. So just be aware, no government entity, Medicare, Social Security, they never make outbound phone calls where they will ask you to provide your personal information over the phone. Okay, so spread the word. Any loved ones, friends or family that are on Medicare, let's just make sure that they don't fall for that scam. Okay. All right, so this is the Medicare roadmap. So when I have a sit-down session or a virtual session with someone, and we're just trying to establish the general idea of what are your options now that you're on Medicare, we use this particular slide. So I'm going to go through this with you. It starts at the top. Okay, so the Medicare roadmap here we're looking at, it starts at the top with the government portion of Medicare, Part A and Part B. All right, so as you're planning retirement and you're trying to figure out when should you start this whole process, okay, you're allowed to apply for Medicare once you're within 90 days of when you need it to start. So I'm talking to people right now that are trying to retire at the end of the year. They need to start Medicare on January 1st. The earliest they can start that process is 90 days prior to that, which is October 1st. And I'm recommending that to everybody, that as soon as you cross into that 90-day window, you want to start as soon as you can. Okay, it normally takes about 2 or 3 weeks to process a Medicare application, but I've seen it take a month. I've seen it take 2 months. So you want to start as early as you can, just to make sure, if there are any issues, you got plenty of time, and you're not, waiting to the last second to try to make all this happen. So retirement planning, this is step number 1 in the whole process. Apply for Medicare once you're within 90 days of when you need it, okay? Now, keep in mind, too, the cost that we just talked about. Part A of Medicare is $0 per month. Part B is $144 a month. Could be higher based on your income, but today we'll use $144. No matter what you do down here, no matter what insurance options you select, you're always going to pay this Part B premium. So keep that in mind as you're keeping track of, what the costs are, okay? So as you can see in this roadmap, it starts at the top, and then there are 2 arrows here pointing to 2 completely different paths. Excuse me, 2 different paths, okay? You have the option to go with a Medicare Advantage plan or a Medicare Supplement plan, okay? So I'm going to walk you through each of these plan types and go through the general structure of the plan, like what the coverage looks like, what the costs look like, and give you an idea. But this is basically what it all boils down to, is one of these 2 options. If you happen to be a government employee or a teacher, you'll have the option of, like in Ohio, there's OPERS, Ohio Public Employee, or STRS, State Teacher Retirement System. So you'll have these 2 options, plus you'll also have the option for their retirement plan. So I talk to a lot of people that are, have that option, and we compare, not these two options plus the retirement plan, and we try to figure out which one makes the most sense. Does it make sense to go with your retiree health plan, or does it make sense to not do that and just go on your own? But for today's purposes, we'll just focus on these two options here, okay? So Medicare Advantage, let's go through that. Medicare Advantage plans, that's also called Part C of Medicare. So when you hear Part C, it's the same thing. Medicare Advantage, same thing. What's very attractive about a Medicare Advantage plan is the cost, the monthly premium. For many of these Advantage plans, the premiums are actually zero. You actually don't have to pay an additional monthly payment. You keep paying the Part B premium, the $144 a month, but there's no additional monthly cost on a lot of these Advantage plans. Okay, there are some that do charge a monthly payment because maybe they have better benefits or something like that, but the vast majority are zero. Okay, which is really attractive. It's really nice. There is a trade-off though. Okay, the trade-off is that what you do end up paying for are your medical expenses at the time that they occur. Okay, so when you go see a doctor, it's usually in the form of a copay. Okay, so when you see your primary care, it's usually a pretty low copay, $5 or $10. If you see a specialist, it's usually around $40. If you end up going into the emergency room, it's usually a $90 copay. A day in the hospital is usually $300 to $350 for each day that you're in there. So, I mean, every test, every visit, every hospital stay, there's always a flat copay or a small percentage that you are responsible for, okay? And what's happening is that the plan is keeping track of what you're spending throughout the year, just like the health plan that you have now. They're keeping track of what you're spending, and then if your spending ever reaches what they call your out-of-pocket maximum, so just like on the plan that you have now, there's a maximum, there's a limit to your plan that if you ever end up spending up to that limit, then you're covered 100% the rest of the year. Okay, so on these Advantage plans, that limit is different from plan to plan, but they're usually right around $5,000. Okay, there are some that are a little bit less, some that are more, but you're basically paying copays out of your pocket until you end up spending around that $5,000. Once you do that, then you're covered 100%. Okay, so no monthly payment, pay as you go, hit 5,000, 4,000, 6,000, whatever the limit is, then you're 100% covered. Okay. Part D of Medicare, D is in drugs. That's the drug portion of Medicare that's automatically included in almost all of these Advantage plans. So you also have copays, not only for your doctor and hospital, but also for pharmacy. So when you go pick up your medications, there's copays for that as well. Okay, so you're basically bundling your hospital, your doctor, and your pharmacy all into one plan for no monthly payment. Now, what's interesting about an Advantage plan, again, this is sold by private health insurance companies. So we're talking, Anthem, Humana, United Healthcare. There's, like 40 companies that sell these plans. Whichever one you choose, they actually replace the government portion of Medicare. Okay, so what that means is that whatever insurance company you pick, you're now using that insurance company for everything, for doctor, for hospital, for pharmacy. You're not actually using the government portion of Medicare. Okay, this replaces that. You still have to pay the Part B premium, but you're not actually using Medicare as your insurance anymore. It's this Medicare Advantage plan. So because the insurance company now takes over as your primary insurance, you have to make sure that you're staying in that insurance company's network. So you'll see this bullet point here. It says provider networks, HMO and PPO. Many of these plans are HMOs, which means that you're in a particular network, usually around the area where you live. And if you go out of the network, there are no benefits. Okay. There are some plans that are PPO plans, which basically give you a much broader selection of providers. If you happen to go outside of a PPO network, there are out-of-network benefits. You're still covered if you go out of network. So that's a very important part of figuring out what company should you go with on the Advantage side. That's part of my job is I'll ask you for a list of your doctors and hospitals that are very important to you. I'll research all the different companies and figure out, okay, this company over here has only 2 of your 4 doctors. This company over here has 3 of your 4, and this company over here has all of your doctors in the network. So you want to make sure whatever Medicare Advantage plan you sign up for, that your providers are in the network. okay? And we help you with that. And there is an open enrollment period every year. So Medicare, the annual open enrollment period is October 15th through December 7th. So if you're on a Medicare Advantage plan, when this time period comes around, you can switch to another Medicare Advantage plan, and you're allowed to do that every single year. So, some people that, maybe the plan changes what medications they cover, or, maybe a doctor drops out of the network, whatever happens, you're allowed to switch it to something else during that time. And that switch actually goes into effect as of January 1st, okay? So if we go back up to the roadmap here, that is kind of a crash course here in how a Medicare Advantage plan works. Now on the other side here, Medicare Supplement, you'll also hear the term Medigap. So Medigap, Medicare Supplement, same thing, same terminology, talking about the same product, okay? It is essentially an exact opposite of everything that I just went over for the Advantage, okay? So let's go through that. So with a Medicare Supplement plan, it's the kind of the opposite concept, where you have a higher monthly payment that you pay, but you pay very little out of your pocket in medical expenses. For example, there is a supplement plan called Plan G. G as in girl. Plan G is probably at this moment in time, it's the most commonly purchased supplement plan out there in the market. With Plan G, it covers nearly all of your medical expenses. So if you go back here and you look at Part A, remember those expenses we just went over for inpatient hospital? It covers 100% of all of your Part A expenses. So if you get admitted into the hospital, skilled nursing facility, hospice, covers that 100%. Under Part B, this 20% that you're responsible for, that supplement covers that entire 20%. The only thing that the Plan G does not cover is your $198 deductible. That's it. So when you sign up for Supplement Plan G, your out-of-pocket maximum, the most you can spend in medical expenses throughout the year, is $198. Now that comes with a monthly payment. And that monthly payment is based off of age and gender and where you live. Someone who's 65, the monthly payment on Plan G right now is anywhere between $105 to $120 a month, somewhere in that range. So it's a lot higher than zero on the Advantage plan, but again, the trade-off is you have a lot less to spend out of your pocket if you had a lot of medical expenses. All right. Now, Part D of Medicare, okay, the drug coverage of Medicare, it's not included in any supplement plan. Okay, that's why you see a plus sign here on the roadmap, and there's a separate Part D drug plan. So when you go this path with a supplement plan, you have two plans that you're going to purchase. You're going to purchase a supplement for medical expenses, then you're going to purchase a drug plan for your medications. National average, it says here, is $32 a month. Most people are right around $20 a month for their drug plan. So when you're trying to figure out your expenses here, monthly expenses, you have your Part B premium at $144, your supplement, let's meet in the middle and say $115 a month, and then you have your drug plan right around $20 a month. So those are three premiums there if you decide to go that route. Now, one completely different aspect of a supplement plan to an Advantage plan are networks of doctors and hospitals. So remember, back on an Advantage plan, the insurance company replaces Medicare, so you have to make sure you're staying in that insurance company's network. That is not how this works on the supplement. It doesn't even matter what insurance company you pick. The insurance company does not determine your network, because the supplement actually acts as a secondary insurance plan to Medicare. Medicare is considered your primary insurance when you go with a supplement. So what that means is that you're allowed to see any doctor in any hospital in the entire United States. As long as they accept Medicare, your supplement has to cover the expense. Okay, so Medicare is your network, not the insurance company on a supplement. Okay, so I talked to some folks that, maybe they are retiring and they want to travel a lot. Maybe they, spend a lot of time with family in another state, or maybe they even have a home in another state. When you're on an Advantage plan, you really have to pay attention to networks and where you can go when you're traveling. With a supplement, you don't really have to worry about that. You can go anywhere in the country as long as they accept Medicare, which almost all of them do. Like 93% of the doctors in the country take Medicare. So you're covered very well nationwide on a supplement, but again, comes at a cost. Okay, so that's what it comes down to, is trying to figure out which option to go with. Do you want to pay very little per month, but potentially a much higher out of pocket on the Advantage, or pay a higher monthly payment on a supplement and pay very little in medical expenses? So those are your main options there. And one question I get all the time is, well, you know, can I start with an Advantage? Because right now I'm perfectly healthy and I don't really go to the doctor too often. Can I start with an Advantage, and can I just switch over to a supplement plan when that time comes? The answer to that question is maybe. Okay, so I'm going to tell you one very important rule that you need to know when you're trying to figure this out, is that when you first get enrolled into Part B of Medicare, there is a 6-month window that you have from that time where you can enroll into any supplement plan through any company that you want, and it's guaranteed, meaning you do not have to answer any health questions. Doesn't matter, healthy, sick, you can get any supplement plan that you want through any company you want. But that time period only lasts for 6 months. So if you start with an Advantage plan, and let's say you're on it for a year or two, and then you decide that you want to switch from an Advantage over to a supplement, you're allowed to during this open enrollment period. However, it is no longer guaranteed. Okay, so you have to qualify now based on your health. So when you go to switch from an Advantage over to a supplement, they're going to ask you, do you take any medications? What are those medications for? Have you had a heart attack or stroke or cancer? And based on your health history, they'll decide whether they will allow you to switch or not. So I've talked to some people who have signed up for an Advantage plan. Something happens to them, they get diagnosed with, you know, some major condition. Now they want to switch over to a supplement, and they can't do it now. You know, they're not allowed switching. So the one and only time you can get a supplement plan guaranteed, no health questions asked, is when you first get enrolled into Part B of Medicare. So keep that in mind as you're trying to make a decision. All right, let's fast forward here a couple slides. We're almost done, just a few more to go. This is the grid of supplement plans that you have the option to select. The main two that we focus on are Plan G and Plan N. You have 6 other ones here to choose from, but as you can see, there's some gaps here. Some don't cover skilled nursing, some are only 50% or 75%. So we really don't sell those because, you know, they are lower in price, but not by a whole lot. So the main two that we focus on are G and N. All right. Couple more slides and then we're all done. You know, if anything was confusing up to this point, just bear with me here, because in my opinion, this is the most confusing part of Medicare, and it has to do with prescription coverage, and it's the term that you may have heard it. It's called the donut hole. Okay, so we're going to kind of go through that, and what you're looking at here on the screen, the structure that you're looking at applies to every drug plan in Medicare. Okay, so it doesn't matter if you're on a Medicare Advantage plan, if you're on the supplement, you got that separate drug plan. This structure applies to all plans across the board. Okay, so there are 4 stages of prescription coverage in Medicare. You have the deductible stage, initial coverage period stage, coverage gap, also known as donut hole, and then you have the final catastrophic stage here. All right, so your deductible stage is $35. So that is actually excluded on some plans. So you might have a deductible, you might not. But once you get through your deductible, you now are in this initial coverage period. So all that's happening in this period is that when you go to the pharmacy, you're paying co-pays for your medications. Okay, so you're paying, let's say, $10 for this medication and $30 for this medication, and then your insurance company is picking up the rest. So what's happening in this stage is that every month you get a letter from your insurance company that gives you a summary of what you did last month with your prescriptions. So that summary will say, okay, last month you filled this medication for $10 and your insurance company paid $30 of that drug. This medication you paid $10 for it, but your insurance company paid $60. And what they're doing is that they're adding up what you're spending and they're also adding up what the insurance company is spending, and they're coming up with a grand total of medical expenses, prescription expenses for the year. So that'll happen each month throughout the year. And then if your total prescription costs ever reach this number here, $4,020, and again, that's you and the insurance company combined to hit that $4,000. If you hit that number, then from here on out, you are now in what they call the donut hole. Now you no longer have copays for your prescriptions. You are now responsible for 25% of the cost of your medication. Usually in this stage, what you're responsible for, what you pay actually ends up going up. Not always, but most of the time. So donut hole historically has not been a good thing for people because they have to spend more. Now you're in this stage, you're paying now a percentage of all of your medications. Now, if you go from this 4,020, you're paying now a percentage. If your costs end up reaching 6,350, okay, that's not on top of the 4,000. That's just going from the 4,000 to the 6,000. If what you end up spending hits that 6,350, now you're out of the donut hole, and now you've hit the final stage where you are not going to pay any more than 5% of your medication. Your costs are going to go way down. Okay, so crazy structure, I know, but your experience in this has everything to do with how many medications you're on, how expensive they are, and I have some people that never hit the donut hole, and then I have some people that they blow through this whole thing in 4 months because their medications are so expensive. So that's part of my job too, is when you're ready to retire and you have a list of medications, I can research those and I can actually show you what your experience is going to look like. What month are you going to hit the donut hole, if you're it at all, what your costs are going to look like. So we help you figure that out and give you the what you can expect in the upcoming year. So I know that was just an unload of a lot of information. If you have any questions, you're welcome to reach out anytime. Okay, I know we're coming short on time, just a couple more slides, but I wanted to talk about the penalties, okay? So there are 2 penalties left that we haven't talked about. It's the Part B penalty and the Part D penalty. The Part B penalty is not on this slide. Because it's what I've already mentioned at the beginning. The Part B penalty simply says as long as you have coverage through an employer, and as long as that employer has 20 more employees, there is no Part B penalty. You will not be penalized by not signing up for Medicare and staying on your employer plan, okay? However, the Part D penalty goes one step further, okay? It says, okay, if you have employer coverage, that employer coverage has to be deemed basically it's got to be good enough according to Medicare. Okay, there are standards that Medicare puts in place that your employer plan has to meet when it comes to prescription coverage. If it doesn't meet that requirement, it is called non-creditable. Okay, so what you want to do, if you're on an employer plan, you want to ask someone in HR, ask your employer, is my health plan considered creditable according to Medicare? If it is, then you're fine. There is no penalty. However, if you find out that your plan is non-creditable, what that means is that you could be penalized later when you eventually transition on to Medicare because you are on a non-creditable plan. It's not a large penalty, but it is a monthly penalty that you pay for the rest of your life. So if you find out you're on a non-creditable health plan, it's not common, it's rare, but it is out there. But if you find out you're on a non-creditable health plan through your employer, give me a call and we'll walk through some strategies on how to avoid paying that penalty, okay? There's several strategies. I'm not going to go through all that today, but just make sure you know whether your plan is creditable or not in the eyes of Medicare. All right, I know we're coming real close on time here, but I want to just hit a couple highlights on HSAs, okay? Just remember, as you're trying to plan whether you should draw Social Security or not and when to do that, keep in mind that as soon as you draw Social Security, let's say you start drawing at 66 because that's your full retirement age, or 66 in a couple months. When you do that, you're actually automatically enrolled into Part A of Medicare. Okay, so drawing Social Security triggers automatic enrollment into Medicare. And remember the rule we talked about at the beginning that if you are enrolled in Medicare, you can no longer contribute to your HSA. So it's a bit of a domino effect here where, if you draw Social Security, you got to keep in mind, if you're on an HSA through your employer, you're going to get enrolled in Medicare and you can't put any more money into that HSA. So just got to be aware of that unfortunate consequence there. So any money that's sitting in your HSA, once you hit age 65, if you want to take it out and use it for something other than a medical expense, like, I don't know, you want to go on vacation with it or, buy a hot tub or something, you can do that without having to pay a penalty. You still have to pay taxes on it, but no more penalty for taking that money out after age 65 for something other than a medical expense. Now, there's a contribution limits here that you can contribute as a single and a family. I want to move down to this bottom bullet point here. So all these rules I've been telling you about, if you are enrolled in Medicare, you can't put money in your HSA. That applies to the employee only. That does not apply to your spouse. Okay, so if your spouse, let's say your spouse turns 66 and they want to draw Social Security, they're going to get enrolled into Medicare, but that has actually no impact on your employer plan. It's only you as the employee. That's who they care about, not your spouse. So, just to make it more confusing, but spouse's status of Medicare has no impact on your HSA. It's you as the employee. Now, last slide, okay? Hang with me here. Thank you for hanging in. So the money that's sitting in your HSA, if you have money in there, once you retire and you go on Medicare, you can actually use that money to pay most of your Medicare expenses. So that Part B premium I was talking about, the $144 a month, the drug plan premium, there are some Medicare Advantage plans that do charge a monthly payment. You can use your HSA money for that. The only thing you can't use your HSA money for is your Medigap or your Medicare supplement insurance premium. I don't know why, but you can't. That's the only thing. All right. So we have a lot of people that, are figured that out a while ago, and they have quite a bit of money in their HSA, and now they can, dip into that account, and it, the money went in tax-free, it's coming out tax-free, so you're basically paying for your Medicare premiums with tax-free money. So it's a very useful account if you can build that up. All right. All right. Last goofy rule with Medicare, and then we're all done. All right, it has to do with you signing up for Medicare after age 65. So let's say you're 67 and you're ready to retire, and now you're enrolling into Medicare for the first time. All right. Remember, step one is that you're signing up for Medicare A and B. What they're going to do with Part B, they're going to start it when you tell them to start it. Okay, whatever date you need, you tell them, I want to start Part B on this date. However, with Part A, they actually retroactively start Part A back 6 months. Okay, so like I'm talking to people now that are retiring at the end of the year. January 1st is when they need Medicare to start. So they're signing up for Part A and Part B to start January 1st. Part B of Medicare is going to start January 1st, but Part A goes back to July 1st. Why do they do that? Well, it was originally intended as a benefit because they will retroactively cover any hospital expenses you had going back 6 months. That might help you, might not. But remember, the rule is that if you are enrolled in Medicare Part A, you can't contribute to your HSA. So because they take it back 6 months, you have to stop contributing into your HSA 6 months before you plan on enrolling into Medicare. Go figure that one, right? But that is what you have to do. So as you're planning retirement and you're trying to figure out when should I do this, when should I do that, that's what we're here for. We are your resource to help you put a timeline together and help you make sure you don't miss anything, and you hit the right dates and you stay on, you do things when you need to do them. So there's a list of contact information here on this last page. My information here at the top. Heather Blue is a colleague of mine. She does an excellent job. She specializes in Medicare. She also specializes in folks who are not yet age 65, who need to find their own individual health plan. I do that as well. So Heather and I are your resources here for Medicare and individual, and some other local Social Security office phone numbers and other resources here. So I know we went a little over on time. For those of you still on the call, thank you very much for hanging on. Again, we'll send out a copy of the presentation as well as a recording link, and any questions whatsoever, you are welcome to reach out, email, phone call, anytime. Thank you so much for joining, and have a great rest of your day. And let's see, Cindy Heron, got your question? Yep, we covered it. All right. Hey, thanks. You guys have a great day.